What's up everyone, it's Caddy with MoneyVest. So in this video, I wanted to go over the bond market. The yields are dropping pretty aggressively, especially on the longer end of the curve. We are seeing the 10-year, the 20-year, and the 30-year treasuries drop and come down to their lowest levels since September. And there are some very critical levels and thresholds that I think we still need to watch. And if we can crack below those levels, TMF and TLT are obviously going to have a very strong rally higher. I'm going to go over my breakdown of my trade, the bond trade that I've taken on, and of course the targets that I have and I'm watching moving forward. So hope you all enjoy this video and find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. Again, we'd love to have you on board. We've got over 20 plus Discord channels. You get access to all the trade alerts, find out exactly when I'm buying and selling individual stocks and ETFs, full access to all of our spreadsheets. I'm going to go over one of our more important spreadsheets in this video, and you can also unlock and get access to over 40 plus private videos, members only videos. Everything's going to be available that you can access. And this is, again, a community of investors and traders globally. We've got over thousands of members from all over the world, kind of helping each other, supporting each other, sharing the best tips and strategies in their research and their analysis. So if you want a place, a community, it's a safe place where you can share your analysis, research, and bounce off ideas off of other members as well. Definitely consider joining. Link's going to be down below. There is a 16% annual discount, and I've opened up a few more spots for the month of November if you want to join and access all of the information that's available on there. So this right here is my trade. And this has been, we've been talking about the bond trade for last entire year. Yields have been continuing pushing higher, but specifically mentioned that I think it's going to be very, very important for us to be a little bit more careful when it comes to the bond market, because number one, we're trading a leveraged ETF, right? So levered ETFs do have that decay factor kind of built in, because it's not really trading off of supply demand. It's trading off of the contracts that it's built on, right? Futures, options. And for that reason, I think it's really important for us to be very careful, kind of time this well. And I sent out an update or an alert on TMF that I was buying a little bit more aggressively. I think it was last week or the week before that when I ended up picking up a lot of shares at 475, because I was starting to feel that we're coming towards the end of the hiking cycle. That's something that I've mentioned before, is my main thesis is going to be built on the Fed's language and the tone of what they're planning to do with interest rates. And number two, what we expect in terms of the refunding program from the fiscal department when it comes to the treasuries as well, right? So we know that $1.6 trillion is still going to be due in the next couple of quarters. Like this quarter, we're seeing another $800 billion from the Treasury Department. Next quarter, we're going to see another $700 billion from the fiscal department. And for that reason, there's a possibility that, okay, we may see some more supply, so imbalance of that supply demand, causing prices to come down, yields to continue to push higher. But there's another factor at play, which is obviously the hedge funds and the institutional investors that continue to short the heck out of the Treasury Department, or the Treasury securities, not department. And if they start to cover their positions, that's going to lead to prices going higher, yields coming down. So what we're really witnessing right now is that if you come over to the 10-year Treasuries, we're seeing it drop a little bit over 1%. So now sitting at under 4.4% at the moment. So we're already starting to see this drop below 4.4%, so down almost 1%. And like I said, it's coming down to its lowest levels since September. And as a result, TMF obviously is higher a little bit, up over 3%, trading back up to over $5, a level that we haven't quite seen since September 26th. And TLT also is up a little bit over 1% pre-market. Now, the levels to really be paying attention to, and here's my plan with this trade. It's going to be quite an interesting sort of topic, because, when it comes to these macro plays, these are very tactical, right? So you have to be understanding of where interest rates are going to go, right? You're making essentially a probability bet on where interest rates are going to be, where inflation is going to be, where recession probabilities are. So there's a couple different things that I want to touch on, which is going to be debatable. And I again need your help and your engagement and collaboration with that in the comment section down below. So definitely do let me know what your thoughts and your analysis is. But the way I see it is, if there is a recession, okay, in the next couple of quarters, whether it's the first quarter of 24 or second quarter of 24, if there is a recession, and with that recession, if inflation's back down to under 2% with the Fed's target, interest rates can get cut, and they can get cut very, very quickly and very aggressively from the Federal Reserve standpoint, because at that point, not only have they achieved their goal of bringing inflation down, but there's also a recession, so there's an incentive for them to cut rates pretty aggressively. So that's number one. That's a huge bull case sort of scenario and thesis for the bond market and for equities as well. Now, if there is a recession, but inflation's not down to 2% or lower, and there's any persistence in the inflation numbers, if they continue to stay elevated, or there's a level of stagflation involved with where we are with overall prices, and there's recession, if unemployment starts to go up, jobless claims did increase to 230,000, but still under 300,000, still under the concerning level at the moment, then that's a different story, because then the Federal Reserve will continue to prioritize their fight on inflation and may not cut rates even if there is a recession or even if there's higher levels of unemployment. And for that reason, the bond market, especially on the long end of the curve, could continue to be a little bit more elevated. Yes, we're seeing a pullback right now, but that could stabilize and that could continue to move back higher in case the Federal Reserve does not embark on this rate cutting journey as what the market's already pricing in. The market's pricing in 4 rate cuts for 2024. That may or may not happen, right? So we're going to have to wait and find out. So it's a very sort of take it step by step trade. It's not something that you can kind of base your analysis off of today, because we are really just trying to understand what is going to be the path of interest rates moving forward, because we know the Federal Reserve has paused right now, at least for right now, and the market's not expecting any more rate hikes from the Federal Reserve. But December SEP, again, that's going to give us a little bit more insight into where interest rates are going or where they could be in 2024, 2025, and whatever Jerome Powell says then. Again, the market's going to try to read between the lines and try to understand and interpret whatever he's talking and saying. So, this is going to be an ongoing trade where I continue to evaluate certain things and certain situations. So from my understanding, if the 10-year yield can crack below 4%, I think that would be probably the best thing for the bond market and for the equity market as well. And there's a high probability for us to see below 4%, and I'll tell you why. So if you come over to this right here is the money market funds, right? So we've talked about this before. And this, again, is a spreadsheet that's available for all the members. You can access this whenever you like. There's a lot of other tabs, so you can literally just switch between different tabs to get a good understanding on macros and different data points. But the current read for the money market funds, money literally just sitting on the sidelines in cash, is close to $6 trillion, right? 5.9 trillion. And pension funds and endowment funds are some of the biggest contributors to these money market funds here that are just sitting on the sidelines. So that is 4.5 times higher than the median read over the last, I think, 60 years or something. So we're going back as far as 1980s. So it might be a little bit over 40 years. But the bottom line is that there's a lot of cash just sitting on the sidelines. And you know what happens? It's not just panic selling, right? There's also something called panic buying, right? And panic buying happens during times of FOMO, right? Panic selling happens during times of fear, but panic buying happens during times of greed and FOMO, of fear of missing out. And that is something that I do believe could potentially happen and take place, and that could drive yields even lower, and that could really help yields crack below that 4% level. And what I mean by that is, a lot of the endowment funds and pension funds, they want to lock in these higher rates. They haven't seen the 10-year treasuries trade at almost 4.4% in over 16 years. And when yields were at over 5%, right, there was anticipation that they're going to keep going higher, right? There was anticipation that, okay, we're going to see higher yields, maybe 5.25, maybe 5.5, maybe even 6%. But the moment they start to reverse and drop back lower, so we're already down 62 basis points and down 12.5% from those levels, what's going to happen is endowment funds, pension funds, a lot of the capital allocators are going to look at their bond yields and their bond portfolios, and they're going to be like, okay, I think it's time to lock in these 10-year rates, 20-year, 30-year, right? So 30-year sitting at well over 4.5%. It's a pretty solid yield, right? So for the next 30 years, 20 years sitting at just over 4.77, again, very, very solid yield to lock in for 20 years. And if that demand starts to come back into the bond market, well, guess what? Yields are going to start dropping even further. Prices are going to start going back up because that's the demand doing its thing. If the demand overpowers supply, prices go up, yields continue to come down because of that inverse correlation. So that is another big sort of factor at play here. But there's a couple different forces. Like I said, on one hand, you've got the Treasury Department continuing on this refunding plan with the deficits and issuing a lot of bonds. On the other hand, you've got hedge funds shorting, and they're also going to be covering at some point, especially now when prices are going higher. So they're going to want to cover fairly soon. And on the other hand, you've got a big decision to be made from a liquidity standpoint, because there's so much money market funds sitting on the sidelines, and a lot of the pension funds, capital allocators, endowment funds, they're going to want to lock in a lot of those rates, fairly soon. So there's one supply factor, there's two demand factors. And for that reason, it's possible the yields continue to see a bit of a pullback. But then there's also an overarching debate over recession and inflation and interest rates, which is really what's going to dictate where interest rates end up going over the next 6 to 12 months. So there's a lot of things to analyze. Like I said, I don't have all the answers for us today, but TLT, next resistance really going to be $91. And beyond that, we're going to be watching $96. That's going to be in line with that 200 simple moving average. And when it comes to the overall trend, we were in this very much of a downtrend, but more recently, we've started to make these higher highs, right? So we just printed a new higher high on TLT. The next level that I'm really watching is a breakout over $91. And for TMF, a breakout over sort of like this area of resistance is going to be the one to watch, even though it doesn't really matter because TMF is a leveraged trade to begin with. So there's more of an underlying analysis on TLT, but TMF, anything over 550, can really put us on the map to getting up to as much as $6, $6.35, even to as much as that 200 estimate at $7 per share as well. But again, a lot of that depends on the factors that I pointed out earlier. So that's really what the main focus is going to be moving forward. And I'll continue to update you guys on the Discord as well. So I hope you guys enjoyed this video and found it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord Patreon is going to be down below. Again, you get access to everything, all the benefits, research, analysis, alerts. And as always, happy investing. And I will see you all in the next video.